Good afternoon, everybody, and thank you for joining us for our inaugural 2021 virtual discussion at the Money Marketeers of NYU. We've got a real treat for you today. We've got our distinguished guest today is Lord Governor Mervyn King, former BOE governor. But before we dive into that, just one or two moments of housekeeping on behalf of the board and the organization as a whole. As mentioned before, we are the Money Marketeers of NYU. Our goal, our purpose is to raise funds and support students focused on economics and markets at the Stern NYU School of Business. And today, as I'd mentioned, we have Governor King, who is a professor, and I believe he's got a dual mandate both at the School of Law as well as the Stern School of Business. Our organization was founded in 1946. And historically, we've always had events inside in New York City where we would have a dinner, where we would have the ability for our guests and our members to have the interplay and the discussion with our esteemed guests. Unfortunately, with Corona and COVID right now, we cannot do that. So this is the next best thing. So as part of our mission, you should see a chat box that's available to you. Please feel free to ask questions along the way. We will be saving some of those questions towards the end of the program, primarily. But yeah, that's really the long and short of it. And if by chance you have some interest in joining our organization, please go to our website, and all the information is there. Or reach out to any of the board members that are listed on the website. We'd be happy to get in contact with you and bring you aboard. So enough of that. Now on to really the highlight of my career, certainly. Our esteemed guest this afternoon is Lord Governor Mervyn King. His pedigree, his experience really are second to none. His education at both King's College, Cambridge, and St. John's College, Cambridge, as well as Harvard University. And then he worked as a researcher on the Cambridge Growth Project, and he also taught at the University of Birmingham, Harvard, as well as MIT, and then became a professor of economics at the LSE, the London School of Economics. He then joined the Bank of England in 1990 as a non-executive director and became the chief economist in 1991. In 1998, he became the deputy governor of the bank and then a member of the Group of 30. Governor King was appointed as governor of the Bank of England in 2003, succeeding Edward George. And most notably, he oversaw the bank during the financial crisis of 2007, as well as the Great Recession. Governor King retired from office as governor in June of 2013 and was succeeded by Mark Carney. He is also appointed a life peer and entered the House of Lords as a crossbencher in July of 2013. Since September of 2014, he has served as a professor of economics and law with a joint appointment at the New York University Stern School of Business, as well as the New York University School of Law. Good afternoon, Governor King, and thank you so much for being part of our organization and this event today. And I might add a special thank you as well to Haver Analytics for being so kind as to sponsor this event.
Alan, good afternoon, and to everyone on the webinar. It's a pleasure to join you. A long way away. I wish I were in New York, but sadly I'm here in London.
Yeah, well, hopefully the weather is somewhat decent and you do get some time outside. If you don't mind, if you're okay, just jumping straight into it, you've over the last few years have published two books, specifically The End of Alchemy, where you really focused on this sort of hybriding, if you will, or the coalescence of both technology, along with some more traditional aspects such as paper money, as well as the extension of credit. But with your latest book, with John K., Radical Uncertainty, you take that yet a step further, I would argue, and also start looking at, let's call it rational or the rationale determinants of decision-making, cognitive biases. All that you've termed radical uncertainty. By way of level setting for us right now, could you give in your own words a sort of broad spectrum analysis of that terminology, how you frame it overall, if you don't mind?
Well, I used the phrase radical uncertainty in The End of Alchemy, published in 2016. And John Kay and I had worked together for a long while. We wrote a book on tax back in the late 70s. And after the financial crisis, we both realized, coming from very different directions, that we thought we couldn't understand what happened without thinking in terms of radical uncertainty. So what is it? Well, in essence, it's any uncertainty that you cannot quantify. If you can quantify uncertainty, For example, when you toss a coin, it comes down heads or tails. You don't know whether the next toss will be head or tails, but you know if it's a fair coin and you could have measured it before, that it's 50-50, and probabilities mean something in that context. We're also, I think, used to the idea that there are some kinds of uncertainty that we can't even contemplate. Black swans, Nassim Taleb described them as things you couldn't imagine until you'd actually seen an example of it. But actually, in our view, most uncertainty that's relevant to the business world, probably to our own lives and to collective decisions through governments, takes the form of uncertainty which can't be quantified, but yet they're not black swans. We know something, but not enough. And I think the classic example of radical uncertainty is COVID-19. Because back in the summer of 2019, when John and I were finalizing the book and sending it to the publishers, we wrote in the book that we should expect at some point to be hit by an epidemic of an infectious disease resulting from a virus that does not yet exist. And that wasn't foresight. It was a statement of the fact that we knew there were things called pandemics. We knew there were things called banking crises. But knowing that did not enable you to make a statement of the kind, you know, the probability that a virus will come out of Wuhan in China in December 2019 is 17%, 37%, or whatever. That statement would have been meaningless. It would have confused everyone. And in many ways, the best example of this is the decision that President Obama had to make in the White House Situation Room before sending the Navy SEALs into the compound in Abbottabad in Pakistan to capture Osama bin Laden. Because the question he asked in that Situation Room was, you've identified, he was talking to various CIA operatives, you've identified that there is a man living in that compound. Is it bin Laden or not? Well, it was either yes or no, but of course no one really knew. And after the intelligence failures in the second Iraq War, Congress had actually mandated the CIA to provide advice and briefing to the president in terms of probabilities. So one of them said they thought it was an 80% chance that the man was bin Laden, another one 50%, someone else 60%. And after the event, President Obama gave an interview and he said that expressing this in the form of probabilities was confusing rather than helping the decision. And in his memoirs that have just come out, he describes where he says, this was, hey guys, he said, this is a 50-50 call. By that, he did not mean that his own judgment that the probability that bin Laden was the man in the compound was 50%. What he meant was, we don't know. And I think the essence of so many decisions in practice is that they are neither simply turning the handle of some statistical distribution and finding out what the outcome is this particular week or day, nor are they things which are completely unimaginable. They are events which we can get our heads around, but we do not have enough information in order to quantify the uncertainty surrounding it.
So with that, thank you. But with that in play, when applying something like radical uncertainty to a discipline such as economics, monetary policy, where there is a plethora of data, of points of information that either the academic, the professional body can start to ascertain, what is there a coefficient of radical uncertainty that should be played into that? Or is that, how do you envision that concept then, for example, in markets and things of that nature? Is there a reprice that needs to be done in this time frame?
Well, I think it's a recognition that, to use the technical phrase, the world is not stationary. That is, that what happens today or tomorrow is not just a repetition of some underlying stochastic process, which comes on top of a fixed set of laws of motion for the economy. The economy is always changing. And so it's a terrible mistake just to take data from the past and assume that they will be the guide to what happens in the future. Again, I think COVID-19 is a good example because the same problem occurs in epidemiological models as in economic models. These models can be very helpful in understanding how the world works. You get insight from looking at the models. What you don't get is a forecast of the future. And it was very instructive that the attempts to use epidemiological models to forecast the path of COVID-19 were very poor. And they were poor because key parameters in those models were things that we didn't know and couldn't know until we had done a lot more study, scientific study, of the nature of the virus, how quickly it was transmitted, the mortality rate of the virus, and so on. So models can be very helpful in thinking about the world. They give you insights. They can be helpful in telling you what kinds of information it's important to go out and collect, but they're not good at predicting the future or giving you forecasts. That you need judgment. And each event that we confront is a unique one-off event. And most decisions are of that kind. You can learn from the past, but it's a terrible mistake to construct some black box model and tell your junior staff to turn the handle and give you a forecast of what's going to happen.
Right. With that as sort of that thematic context, let's look at something maybe a bit more murky. So in the market world, certainly in modern days, we have a plethora of information. There's almost an equality of access to data, give or take, that anybody can effectively get their hands on. When we shift it more towards, let's say, government and things of that nature, if you wouldn't mind, share some thoughts on how, when you get a little bit more murky, where there's much more human capabilities and human decision making, where does radical uncertainty lie in that regards?
Well, let me use COVID-19 again as an example and explain where I think our government made a mistake in communicating about COVID-19. What we've seen in the UK is that the government has perhaps wished to sound optimistic. It's claimed that these are the measures that will enable us to combat COVID-19 and beat the virus, in their words. And every few weeks, they've had to change the measures and the tactics they've adopted. And if they had started by saying to people, this is a new virus, we've never seen it before. We understand something about pandemics. These are the measures that we know in general we will have to take. But this is bound to be a process of trial and error. And we're going to learn about this virus as we go along. And you should expect us to change the measures that we are either recommending or mandating as we get through this in order to best combat the virus. But this excessive confidence, this excessive certainty early on is damaging to credibility, because after you've reversed course 3 or 4 times, people just lose faith and lose confidence in your honesty, because you're not being genuinely transparent. You're actually pretending to know more than you can possibly know. Right. And I think this is an aspect of policy which is mirrored in many expert analyses, where you get bogus quantification, where you get people who will tell you exactly what the quantitative answer to a question is, even when they cannot possibly know that. And we had an example in the UK in the last 4 or 5 years in which both sides of the debate on Brexit argued that they knew the quantitative implications of leaving the EU or the benefits from staying in. And this was simply false. The official policymakers would say this is an unprecedented event, and yet their staff would then follow in the next breath to say, and this will lower GDP by 4.9% or some equivalent number. And it doesn't make sense to make those claims, because it was the exactly claims of that kind that discredited the Remain position in the referendum campaign, when people could see that they were being sold this as propaganda. This was a line that the government hoped would persuade people to vote to remain. But the arguments they were giving were not arguments that they could possibly know were true. And that exaggerated quantification, bogus quantification, actually damaged, I think, the credibility of the government at the time.
But in utilizing this, let's almost call it the coefficient of we've never seen this before, so we're going to learn about it as we go. You had mentioned something about a credibility gap, or the concerns on credibility, I think is probably the more appropriate paraphrase. What is threading the needle between these two sort of scenarios of saying this is unprecedented, but we as your government or we as your leaders believe that this might be the better way to go? Is that something that can be sort of met halfway, or is it best just to sort of go forward with it and recognize that there's pivoting and, as you said, stay as transparent as possible along the way?
Well, as I said earlier, the essence of radical uncertainty is that we know something, but not enough. We'd love to know more. But what's crucial, therefore, is to explain very clearly to people, certainly if it's a policy issue to the public as a whole, what we do know, but also to explain what we don't know. And over time, we may learn more, and we can explain that as we go along. That, I think, is the essence of successful monetary policy. The central banks that have been successful have essentially provided a regular narrative about their understanding of the path of the economy by explaining what they think they do understand about the economy, but also being very conscious not to make too strong a prediction about what will happen, because they can't know all the things that could happen to the economy in the months and years ahead. And I think by doing that, you create a reputation for knowing as much as anyone else and being good at explaining that through the narrative, but also by being honest in explaining what we don't know. And that's the way in which people start to trust you. And we had that experience at the Bank of England on the Monetary Policy Committee. People said that they trusted the Monetary Policy Committee because there was a process of debate on the committee and various different viewpoints or hypotheses about the economy were put on the table, tested, examined, and people didn't always end up agreeing. So what you had was a situation in which there was a great deal of transparency, but it was transparency about the understanding of where the economy was going. And what I was very resistant to doing was publishing numerical forecasts for, say, unemployment, or certainly a point forecast for anything, because that was meaningless. We simply did not have the knowledge to make that kind of forecast. We kept stressing the uncertainty, but we could try to identify and explain the risks on either side of what might be a central view. That, I think, is where you can build up credibility over time by portraying a narrative which, in the end, people can see, yes, this is consistent with what we know about the economy, but they're not pretending to know more than they can.
Interesting. On that last point, and if I might draw your attention to the United States, where I am, and a few people on the webinar are on also. So if I'm hearing correctly, any thoughts on this 2% inflation line as sort of being one of those guiding barometers as to the efficacy of monetary policy keeping inflation in check, or do you think that is a broad enough tool at this stage of the game, not hemming and bolster or basically hemming in monetary authority from doing anything?
No, I think it's a sensible target to set for central banks. I think 0 is too extreme because we don't capture in our price indices the quality improvements of many goods and services. Remember, central banking independence and inflation targeting was introduced after a period when even the US had double-digit inflation. We had 27% in 1 year. So to get close to 2% from the perspective of those days is nirvana. So I think having a precise target is sensible because it shows that the central bank is mandated to try to aim to get inflation at 2%. It won't achieve it exactly at all, but nevertheless, that's what it's trying to aim at and achieve. And what that is then a benchmark against which the central bank can explain its actions in terms of unexpected surprises in the economy, or explain the reasons why it decided to tighten or to loosen monetary policy. I think that makes a lot of sense. Where I'm a bit more skeptical is the path down which central banks have been going in recent years by trying to predict where they will set interest rates. You can't give forward guidance as to where interest rates will go. You can explain this is where we think the risks to the economy lie. If the risk were to materialize on the upside to inflation, then we'd have to have higher interest rates. And if on the other side, maybe lower interest rates. But none of that enables you to give a precise path for where interest rates will go. And I think the attempt to do that has created, a lot of difficulty.
Yeah, indeed. Sticking with this topic, would you mind giving a few thoughts on your end also about the reaction function that central banks have done during your tenure as well as now in terms of expansion of the balance sheet, in terms of stabilizing the economy overall as an effective tool? And what would be the parameters that you think make a lot of sense to deploy that strategy?
Well, if I think back to the period when I was at the bank and we were coming out of the financial crisis, I think we all knew that we were going to be cutting interest rates to very low levels, close to zero, and increasing the money supply through engaging in quantitative easing, buying government bonds, which boost deposits and in that way increases the broad money supply. And that was done because we were confident that we were facing a very deep downturn resulting from a shock to confidence, which I think around the world, it was very striking that although the banking crisis was focused in the industrialized countries with the epicenter in New York, nevertheless, lots of the countries around the world looked at this and I think said, gosh, if the US can't prevent its financial system from collapsing, how on earth are we going to avoid a very bad outcome? And for a period, actually quite a short period, countries really, there was a very sharp downturn in world trade. So we had to boost demand in the short run. And I think the key point here is that monetary policy is a counter-cyclical instrument. It's not a structural policy. It's not something that can help you shift the allocation of resources from one sector to another or some set of companies to another. It can't deal with long-term problems. What it can deal with is short-term problems in terms of economic activity by trying to find a way either to boost activity or to constrain growth if it's too rapid, so that inflation will return to the target path before too long. And that made a lot of sense at the end of the financial crisis. What nobody at that time expected was that 10 years or so later, we would still be in the position of interest rates being close to zero with a lot of quantitative easing. And what that suggests is that the problems we are facing at present are not cyclical problems. They are deeper problems. Call them structural if you like, but they are problems which I think reflect a chronic misalignment of resources between different sectors in the economy. There are some sectors where there's been overinvestment, the export sector in China and Germany, for example, probably commercial building in the Anglo-Saxon world, and other sectors where there's been underinvestment, infrastructure in many of our economies, capacity to meet domestic demand in countries with large trade surpluses. And the price mechanism has not been allowed to move in order to create incentives to shift resources. So we've had excess capacity in some sectors and insufficient capacity in others. And the interest rates in the economy are now at such a low level that they can't play a role in helping to discriminate between different kinds of investment decisions, good or bad. Interest rates just simply too low to play that effective role. So I would have thought that anybody coming to look at the world economy today from outer space would say, you know, you've had very weak growth for over a decade, but you've had the biggest monetary policy stimulus the world has ever seen. I conclude from that, therefore, that monetary policy stimulus is not the answer to the problem of boosting economic growth. And it would need something very different to do that. And it's not even fiscal stimulus in the sense of cutting taxes and raising spending on anything. It's got to be action designed to enable resources to flow from sectors where there has been excess investment, where there's excess capacity. We need to reduce that excess capacity and shift those resources of capital and labor into sectors where there are profitable investment opportunities. And that will take a long time. And I'm not suggesting that central banks should just raise interest rates, but I am suggesting that they need to be much more overt in saying that monetary stimulus is not the answer to the problems that we've got. And it will take a long while, and I think it will require a rebalancing in much of the world economy. It isn't just any one country, and it's quite difficult for any one country to achieve this on its own. I think even China was surprised when it discovered how dependent it was on demand from the rest of the world, particularly from Europe. And they have been struggling to rebalance their own economy. So all of these things, I think, will require much greater cooperation and a recognition that the answer is not, you know, even more monetary policy stimulus.
You said it's going to take potentially quite some time. Do you have a rough idea as to what you anticipate this kind of transition, this reallocation? Is it a decade? Is it generational? Is it, you know, something along those lines in your estimation?
It's very hard to judge. I think we started to go down the path of a misallocation of resources and falling long-term real interest rates from the early 1990s onwards. So it was sort of 15 years before I think this was a major contributory factor to the imbalances that caused the financial crisis. And we go for another 10 years or so with no attempt really to deal with the imbalances. So, you know, I think it's a decade or so, quite a long period. But if countries could work together and recognize and diagnose the problem correctly, then maybe it could be corrected much sooner. And I do think that one of the minor benefits of the COVID-19 crisis has been that more and more commentators are starting to talk in terms of the need for a reallocation of resources. Mm-hmm. You can see, you know, maybe the things we used to spend money on won't be the things we will choose to spend money on when we come out of COVID-19. We don't know what the optimal size of the airline industry will be in 5 years' time. A lot of uncertainty about that, but a recognition that there will be a reallocation of resources of some kind. And that can't be brought about by aggregate monetary or fiscal stimulus.
That might, my words alone, but that might have to come from the fiscal side of the equation in terms of its incentivizing or at least opening the pathway to a new framework in there. When you're talking about cooperation, something popped into my mind that I would love your thoughts on. As we clearly need this global cooperation in dealing with the pandemic and in dealing with some of the major crises that you've had in your career, any thoughts on where you think the ultimate independence of central banks can go then with this, let's call it more of an exterior view going forward relative to one's home economy? Any thoughts there on where that independent streak might manifest itself in the years ahead?
Well, I think there is we're moving into a period where there could well be a threat to independence of central banks. I think it was the great inflation of the 70s and early 80s that led to a global movement to create more and more independent central banks. More central banks were granted independence in respect of monetary policy. And inflation was seen as the big economic challenge then. And central banks, I think, were extremely successful in meeting that challenge and bringing inflation down. The challenge now is that whereas inflation anywhere between 1% and 2% would have been regarded in the late 1970s or late 1980s or even early 1990s as a complete triumph, it's now being regarded as a failure because somehow we can't get inflation up from 1.2% to 2% or 1.4% to 2%, as if this was a terrible disaster. And that strikes me as a very strange position to take. And it reflects, I fear, the impact of some elements of the academic profession in giving the impression that monetary policy can be set mechanically, as if there is, just turn the handle of a model, goes back to what I was saying earlier on about bogus quantification. You turn the model and it says, oh yes, if we raise rates by 57 basis points, we'll be home and dry.
Right.
And it isn't like that. The world is much more complex. There are many things we don't understand, and we need to take that into account. The consequence has been that central banks have been seen now as having failed to achieve their targets. And they've been pushed into discovering more and more new so-called monetary policy instruments, which I don't think are genuinely new instruments at all. Interest rates and money supply is basically what central banks can do. And as a result, they have been tempted to move into other areas of policy. So you see central banks taking a lot of interest in policy areas which had nothing at all to do with the reasons why they were made independent in the first place.
Yeah.
And what they're doing in essence is moving into areas which governments have the responsibility for. And the danger of that, I mean, a good example would be in QE, purchasing private sector assets, which is a form of, credit allocation. Yes. And if the government decides it wants to favor some sectors over others, well, an elected government has the authority to do that. And if the voters don't like it, they can throw out the elected politicians. But central banks don't have the authority to do that, in my judgment. They certainly haven't been given an explicit mandate to do it, and there's no way voters can throw them out. So I think what you'll see is that the more central banks veer into areas that are properly the domain of government, the governments in turn will say, well, actually, we ought to be having more influence over your decisions. And whether that takes the form of going back from it, formal independence, or whether it takes the form of changing the kind of people who get appointed to central banks so that they're more amenable to political pressure, remains to be seen. But I do think politicians will react. And in a sense, we saw that after the financial crisis, when the Fed felt it had to take various actions to prevent a collapse of the US economy. Politicians were reluctant to take responsibility for doing those things. They were very happy for the Fed to do it. But after the event, then the politicians said, oh, but you went beyond your remit. So we're going to reduce your remit now by changing the legislative framework within which the Fed operates. I think this could happen again, and it will be very unfortunate. We need central banks to keep us on the straight and narrow in terms of a path in which people can come to be convinced that inflation will remain low and stable. And it doesn't really matter if it's not exactly 2%, but it does matter that it doesn't go back towards 10% or even worse into double digits.
Yes, for sure. In your reference to this independence, the first thought that came into mind was FX, because historically the independence of a central bank had a direct correlation to the performance of the underlying currency related to that, that central bank. The U.S. has historically always had a strong dollar policy of that nature. With, let's call it, the introduction of a whole new class of currency that is starting to permeate the global, frankly, monetary system, and simple stuff is Bitcoin, but let's just call it crypto in general. Do you think that that is a train that has now left the station and we can't put the genie back into the box, and that's where we're heading? Maybe not, to usurp the pre-existing currencies, but to be a real player with national currencies going forward.
So I think it depends on the function for these cryptocurrencies. I'm quite convinced that the authorities, both in central banks and in governments, will want to ensure that they have enough information about the way in which these currencies are used, and to place restrictions on what actually goes on there. I think the major currencies will stay. People will use a currency if they have trust in the people managing it. The difficulty with, I think, with many cryptocurrencies is that people have to make quite difficult judgments about whether they trust the underlying algorithms, whether they are confident that there isn't some feature of the algorithm that won't pop up in 2 years' time and suddenly say, gotcha. Or can they trust, what's the relative trust in, say, Apple versus the Federal Reserve? And I think at this stage, governments still have the trust of the population in the way that private corporations probably don't. But it remains to be seen. But I think in terms of a standard of value, that is a function which really only a nationwide institution can play. So people will want to talk about their wages and the prices they pay for the things they buy in restaurants or shops in terms of dollars, not in terms of some other unit. And you don't really want to have friends who use a different unit to you. It's bad enough when those of us on opposite sides of the Atlantic struggle with meters rather than yards, or decimal versus duodecimal currency approaches. But if there were dozens of these different units that were being used for financial calculations, it would, I think, be very difficult. So I don't think there's any threat to that. Where there is a big challenge to the existing financial infrastructure is that the cost of making payments is far too high. And that's where the challenge is going to come. I think the payment system will change very radically, and it's not easy to predict how that will happen. I think it would not be wise for central banks to allow all retail, to create a retail banking operation of their own, to allow everyone to have a computer account with the central bank, because before long that would get you straight to a monopoly position, and monopolies do not provide great services. So I think you need competition in the private sector here, and that's why traditionally central banks have dealt with directly a small subset of institutions, let's call them banks, and then banks deal with the rest of the economy. And there's quite a lot to be said for that, and we'll see how it evolves. I'm sure that there will be quite radical transformations of the payment system in the years to come, and that's where I think the revolution will be. But I think in terms of maintaining the standard of value, how much is a dollar worth in terms of goods and services, that is going to be a function for the federal government, and I hope the Federal Reserve.
Indeed. Just as a reminder to our audience, you do have the option to ask Governor King a question or two. A few people have already done so. I just wanted to remind that. And Governor King, if you don't mind, maybe one or two more questions for me, and then we'll open it up to the audience for a question or two, if you don't mind. And I think maybe what we're going to do is we're going to look at sort of the end result of monetary policy, or the shift in monetary policy since the early 90s that you had mentioned. Is that, we're looking across a global debt burden or a debt pile, whatever the terminology is that's out there, that you've been quoted in the past, and forgive me if I don't get the correct, but at least the essence of it correct, where you recently mentioned significant debt restructuring may be a necessary precondition for restoring the global economy to health, writing down asset values on the balance sheet of many financial intermediaries to more realistic levels and recapitalizations. That is sort of the 800-pound gorilla, I would argue, in everybody's room these days, is saying, the debt pile has helped in times of crises, but it doesn't sort of disappear on its own in due time. And then now we have COVID, which has exacerbated yet again this scenario. If you would, a thought or two on how you could envision this restructuring mechanism happen to be not to be as disruptive as possible, but at the exact same time to not let this extend over a 50, 60, 70-year period where we just sort of have lost half centuries per se.
Well, it goes back to what I said earlier about the need to rebalance economies, to shift resources from sectors where there's excess capacity to those where there are opportunities for profitable investment. And in the private sector, we've seen the rise of zombie companies. This was something which predates COVID-19, and it was true in many economies across the world, both industrialized and emerging market economies. And it was there before COVID-19 hit. COVID-19 has led to a significant further expansion of indebtedness of the business sector and of government sectors, though not by and large of the household sector, which in aggregate has basically doubled the household saving ratio in the last 9 months or so. So I think that as we see a rebalancing of resources, what will happen is that it will no longer be possible to pretend that these zombie companies are going to repay all the principal of the debt. They've been able to service them. The accounting conventions have now changed so the banks can recognize losses. But many of these companies, I think, will be forced to just say openly that they can't repay the debt. And the question is what kind of restructuring we have. I'll come back to that in a second. Parallel to that is that across the world, there are a lot of governments that are struggling now to meet their debt obligations. COVID-19 has been very damaging to a large number of low-income countries, maybe 80 to 100. There are some emerging market economies, large ones that we know about, that are struggling and in the business of negotiating debt restructuring. So this is a major issue, and it's not the problem that we face is that in the past, typically we thought of even a sovereign debt restructuring challenge. Well, it was one country at a time. Now we're going to have lots all at the same time, and that will be true in the business sector. I think this will challenge the mechanisms we have for coping with debt restructurings, but I think it will require a lot of negotiations between creditors and debtors in order to reach agreement. I think no financial intermediary is going to want to press every institution to which it's lent just to default. I think there will be a lot of negotiations. I don't think this is going to be remotely easy to handle at all. And in terms of sovereign debt restructuring, the reason why it's going to be even more difficult than it has been in the past, and it certainly hasn't been easy in the past, is that you can't expect creditors to engage in a voluntary debt restructuring or debt forgiveness unless all creditors are involved. You don't want to give debt forgiveness to someone to whom you've lent, only for that person to repay another creditor instead of you.
Right.
And the challenge for sovereign debt restructuring is that much of the lending in the last decade to low-income and emerging market economies has come from China, from the state banks in China. And unless they can be brought to the table, I think it can be very difficult to get other creditors, whether it's governments or the private sector, to agree to a generous debt restructuring process unless the Chinese state banks are involved as well.
Well, it lends itself back to your statements about global cooperation really to move forward. Yeah.
I think this is going to be really important. Interestingly, President Trump missed an opportunity. He could have said that there are these major imbalances in the world economy. They're caused by some countries having too high saving ratios, other countries too low saving ratios. A symptom of that are the trade imbalances. And if you look at the numbers, he only needed to invite China and the European Union, with the US and the UK on the other side as the deficit countries, down to Mar-a-Lago and do a deal. It was the kind of thing that actually would have played into a small meeting with a deal at the end of it, which would have set out a time path for how we might take individual specific measures that we would decide ourselves, but with the global aim of reducing the imbalances. And that was a missed opportunity. Whether it will come now with the new administration, we will see. But I think it's not enough just to promote fiscal stimulus. You need more than that. It's got to be stimulus of a kind that will enable that rebalancing of the economy to take place.
Wonderful. Thank you so much. If you don't mind, maybe a question or two or three from the audience who've been very attentive, I might add. And you've addressed this before, so I would maybe ask if you could answer it short, because we've already expounded on it. But I think it's a very simple but good question. Governor King, despite all the uncertainty that's out there, in your opinion, what will make, or what I would change slightly, what is one or maybe two things that you think can be implemented relatively quickly that might make our financial system work better, right out of the box?
I think to make our financial system work better, I think you could scrap a lot of the existing regulation and replace them by one of the proposals that I had in the end of alchemy, which is essentially to allow banks to have a special borrowing facility from the central bank on which they can call when there was any run on the bank or shortage of liquidity, with the central bank determining the haircuts on the assets which would be pledged in return for that liquidity. And that, I think, would be able to just take out the risk of bank runs. And we need to apply this to money market funds as well as banks. That would deal with the financial sector, but the real challenges facing us are not coming from the financial sector. They're coming from the fact that we've got excess capacity in some parts of the world economy and inadequate capacity in others.
Yeah, it's more structural in that nature than it is anything directly monetary policy related. This is one straight over the top, so answer as you wish, if you will, but it's an interesting question. Do you believe, or any thoughts on, is the EU impacting UK's supply chain as a way to, quote unquote, punish for Brexit, in your opinion?
No, I don't think it's doing that. I think, after all, trade, the reason why I think that the long run economic consequences will be small from Brexit is because parties to trade that took place before have every incentive to carry on with the same trade. There are no tariffs. So the impact of all this on the wish for companies to trade with each other is negligible. And if two parties engage in voluntary trade, it doesn't make any sense for one of them suddenly to stop that trade from occurring. So I don't think that's the case at all. I do think that there has been a very poor planning by the UK government to put in place some of the procedures that are needed to ensure the speedier transit of trucks through Dover and other ports. But this is a logistic issue on which the UK does not have a good track record. But that's something which will be overcome in a matter of months. It's not a long run issue.
And last question, this is from one of our students that's attending, just heading into university right now. The question is as follows, and it's a funny question, but it's a good question. How long do you anticipate this post-COVID restructuring phase really to last? For context, I'm 19 and considering a career in restructuring.
Well, I don't think it's going to come to an end anytime soon. So it seems to me that if that's your career plan, you're onto a good thing.
Exactly. Governor King, sincerely, thank you so much for taking the time to spend it with us and our organization and our friends of the organization. We're very, very appreciative of your time and your insights. And thank you to everybody else who is joining us. And we wish you all the best. Please be safe. Thank you again, Governor King. And we look forward to having you.
And my very best wishes to everyone in New York and NYU in particular.
Thank you, sir. Be well.
Goodbye. Thanks, Alan.
Yeah, you bet.